Recent market turbulence has triggered significant concerns across Wall Street, with the NASDAQ entering correction territory and post election gains evaporating. This dramatic shift stems primarily from Trump's escalating tariff policies and growing fears about economic slowdown coupled with persistent inflation pressures. The situation has many analysts debating whether this represents a buying opportunity or signals a fundamental market transformation. Looking at the key market indicators, we're seeing some troubling signals. The S&P 500 has completely erased its post-election gains, while the Nasdaq has officially entered correction territory, falling more than 10% from its December peak of 20,173.89. Though the Dow Jones showed a slight uptick of 0.52% to 42,801.72 points on March 7, the Fear and Greed Index has been declining sharply, indicating increasing risk aversion among investors. The sophisticated Pythia predictive model, which combines multiple analytical approaches, offers valuable insights into potential market movements. This advanced system integrates time series analysis using ARIMA and Facebook profit models, machine learning algorithms like random forest and XGBoost, and deep learning through recurrent neural networks LSTM. The model also incorporates sentiment analysis and processes macroeconomic and geopolitical data through natural language processing to capture market sentiment comprehensively. Current Pythia projections indicate a period of high volatility in the coming weeks, with a prevailing downward trend through late March. The model specifically forecasts continued pressure on major indices, followed by potential stabilization attempts in early April. These predictions are generated through continuous real-time updates based on new market data, providing dynamic and probabilistic scenarios rather than absolute certainties. A critical period to watch closely is March 24th to 28th, when several key economic indicators will be released. These include the Consumer Confidence Index on March 25th, quarterly GDP figures on March 27th, and the PCE Price Index on March 28th. These data points, combined with quarter-end dynamics and corporate fiscal declarations, could trigger significant market movements and increased volatility. The analysis identifies three major risk factors, suggesting this volatility isn't merely market noise. First, Trump's tariff policies could have more sustained negative impacts on American companies than initially anticipated, potentially creating a negative spiral effect. Second, the economic slowdown may be more severe than currently recognized, with the Federal Reserve potentially limited in its ability to respond effectively. Third, there appears to be a fundamental shift in market dynamics where the traditional buy the dip strategy may no longer be reliable. Given these conditions, the analysis recommends a more defensive investment approach. This includes considering increased exposure to gold, defensive assets, and maintaining higher liquidity levels, rather than aggressively pursuing market dips. The model suggests that while technical rebounds may occur, particularly in early April, these shouldn't be interpreted as definitive trend reversals. For risk management, Pythia emphasizes the importance of maintaining caution in the short term, particularly given the expected bearish pressure on indices. The high volatility environment requires tighter risk management strategies and careful attention to incoming macroeconomic data. The model suggests focusing on hedging and defensive positioning to mitigate risks in these uncertain market conditions. The data presents a compelling case that current market conditions may represent more than a temporary correction. The combination of technical indicators, predictive modeling, and fundamental economic factors points toward a potential structural shift in market dynamics. This suggests investors should carefully reassess their risk management strategies and consider more conservative positioning until clearer signals emerge. Looking ahead, the market's response to upcoming economic data releases will be crucial in determining whether this correction develops into a more sustained downturn or if stabilization efforts in early April can gain traction. Investors should pay particular attention to both technical indicators and fundamental economic data while maintaining a more defensive posture in their portfolio strategies. The confluence of Trump's trade policies, slowing economic growth and persistent inflation creates a challenging environment that could test traditional investment approaches and require new strategies for success in this evolving market landscape.